Hello, everybody. In this time, we are talking about debt financing. Debt financing occurs when a company raises money by selling debt instruments, most commonly in the form of bank loans or bonds. Such a type of financing is often referred to as financial leverage. As a result of taking on additional debt, the company makes the promise to repay the loan and incurs the cost of interest. It can then use the borrowed money to pay for large capital expenditures or fund its working capital. In general, well established businesses that demonstrate constant sales, solid collateral, and are profitable will rely on debt financing. On the other hand, newly launched businesses that fear uncertainty in the future or businesses with high profitability but lower credit ratings will more likely rely on equity financing. And then we move to debt financing options. The first, bank loan. A common form of debt financing is a bank loan. Banks will often assess the individual financial situation of each company and offer loan sizes and interest rates accordingly. The second, family and credit card loans. Other means of debt financing include taking loans from family and friends and borrowing through a credit card. They are common with startups and small businesses. The third, bond issues. Another form of debt financing is bond issues. A traditional bond certificate includes a principal value, a term by which repayment must be completed, and an interest rate. Individuals or entities that purchase the bond then become creditors by loaning money to the business. And then advantages of debt financing. While each specific form of debt financing has its own unique pros and cons, they all share distinct benefits compared to some other forms of business finance. The first is retain business ownership. Debt financing allows businesses to gain access to capital without diluting their ownership of the company, as opposed to equity financing, which necessarily involves selling shares. This means that the company gets to keep all the rewards of its growth instead of having to share it with risk financer who becomes a shareholder. The second, a high degree of flexibility. Debt financing arrangements are generally highly flexible. Invoice financing agreements, for example, tend to give the borrowing company the choice of how many of their outstanding invoices to raise funds against. This is perfect for businesses that are looking for a term and form of financing that's adaptable to diverse needs. The third, fuel growth with debt. Although an excess of debt can be toxic for a company, strategic debt can be instrumental in fueling growth. Businesses can use the funds they raise from debt financing to invest in research and development, make new hires, buy more inventory, or build resilience against a turbulent market. If the revenue growth they experience because of their investment outweighs the repayment costs in the long term, the move can be considered positive. And then disadvantages of debt finance. Nevertheless, it also comes with some disadvantages. Some of the cons are: the first, interest payments. Debt financing is an obligation to make regular interest payments. This can be a financial burden, especially if the business faces challenges or experiences a downturn. And the second is interest rate risk. Fluctuating interest rates can impact the cost of debt financing. Rising interest rates can increase interest expenses, affecting the profitability of the borrowing entity. And when speaking of financing, there are two other concepts that I may find helpful. One is short-term financing, and the other is long-term debt financing. The third, risk of insolvency. Excessive debt levels can increase the risk of insolvency, especially if a business struggles to meet its debt obligation. Defaults on loans can lead to severe consequences, including bankruptcy. And the four, collateral requirements. Lenders often require collateral to secure the loan, and failure to repay may result in the loss of assets. This requirement can limit the borrowing capacity of businesses with insufficient collateral. And the fifth, fixed repayment obligations. The fixed nature of debt repayments can be a disadvantage during periods of economic downturn or financial stress. Businesses must meet their repayment obligations regardless of their financial performance. And then we move to how debt finance works. The working of debt finance involves a borrower to entering into an agreement with lender, a bank, or a financial institution to receive a specific amount of money. This agreement outlines the terms and conditions of the loan, including the interest rate, repayment schedule, and other relevant terms. Once the borrower receives the funds, they are expected to make periodic payments, typically monthly or quarterly, to repay the principal and interest. The repayment structure of debt financing can vary. In some cases, borrowers may make equal installments throughout the loan tenures, while others might opt for balloon payments, where significant portion of the principal is paid at the end of the term. I think enough for this explanation. Thanks for watching, and don't forget, give this channel with your like, comment, subscribe, and don't forget share. Thank you.